Okay, why don't we get going? Again, good afternoon. Ted Thomas here, joining you from CAFIID's Learning and Sharing Committee. For those that I haven't had a chance to meet that are joining us today, I think looking at the name of lists here, lots of familiar faces. Great to see many of our CAFIID members tuning in right back after Labor Day. For those that I haven't had a chance to meet, in addition to having the pleasure of chairing the CAFIID Learning and Sharing Committee, along with a number of other CAFIID members who are actively involved in that. I'm also senior manager with Deloitte's emerging markets practice. Quite a bit of our work is around emerging market investing, and so today is of particular personal interest. And I suspect for many of you as well, this is a really interesting topic. For those that maybe are tuning into your first CAFIID webinar, this is happily the fourth in our series of 2018 webinars. The Learning and Sharing Committee is responsible on behalf of the members for pulling together conversations like this that are topical and relevant and of interest to the membership as a whole. We've had a number of other interesting conversations over the spring and summer of 2018. And as I was saying to Serge and to Jeff from EMPEA, sort of calling this one our back to school webinar, a little bit tongue in cheek there, but I think a lot of the knowledge and perspective that Jeff is going to share with us today, while it may be familiar in sort of general theme and direction for many of us given our common work, some really interesting data points here, which I think do evoke a bit of a back to school new knowledge and hopefully also generate some excitement. Just a few logistical points before we get going. Again, on the learning and sharing webinars that CAFIID organizes, we do these every 2 months or so, and so you can expect to see the next one in early November. So stay tuned to your emails for that. We have an exciting lineup for 2018, but we're also always looking for new ideas and suggestions, as well as folks willing to be brave enough to put out to the rest of the membership any of your own recent learnings, knowledge creation, data, and so forth in the form of a presentation. So if you're interested in participating or you have an idea for an upcoming webinar, please do reach out to myself or any of the other Learning and Sharing Committee members. I'm happy to provide you all of our contact details. So as I mentioned today, I think we're quite lucky to have this presentation. In the lead up to it, Jeff and I had a number of conversations about not only the mandate of his organization, but also the data that he's presenting today. And for those that know the Emerging Markets Private Equity Association, you'll know that it's a member-based organization as well. And quite a bit of what we're going to see today, I think, is a bit of a peek behind the curtains. Normally, some of this data is only available to the members or at conferences and whatnot that EMPEA organizes. So quite a unique opportunity for our membership to have access to this presentation. Just by way of a short introduction, before I turn it over as well, as I mentioned, we're lucky to have Jeff Schlapinski from EMPEA join us. He's the Senior Director of Research with the organization, and there he provides a wealth of industry data analysis and in-depth reporting along with his team looking at issues of private equity, private capital, and other forms of investing in emerging economies. Some of their key products, and I think we'll probably hear more about this in a few minutes, include quarterly market intelligence for their organization's members, as well as a very interesting global limited partner survey. And then, of course, you're probably familiar with many of their other special reports and research briefs. So with that, a few final logistical points, and then Jeff, I'll turn it over to you. Those that are joining us by computer, you should be seeing the presentation on your desktop now. If you're having any issues, do ping me over the chat or by email. For those joining by phone, you should have received a copy of the presentation. And again, if you didn't get that in your email, please send me an email and I'll make sure that you get a copy as we go. This presentation, as I mentioned, has some very interesting data. Not all of this data is out fully in the public domain, I would say. So we would ask that you treat this as confidential. And if you're looking to use any of this presentation or its information, just do reach out to Jeff in advance and confirm it that that's okay. We really want to make this a conversation as we go, and particularly at the end. So if you have any questions, those on your computer, there's a chat window you can access. If you don't see it, there's a little bubble in the bottom left-hand corner of your screen that should open up the chat window. Drop your questions in there as we go, or feel free to send me an email with questions, and I'll field those over to Jeff. We're going to try to field the questions at the end of the presentation, but Jeff has agreed to pause as we go and dive into any dialogue or conversation if you have a burning question or, let's say, a hot pursuit. So if you do, please just flag that you'd like to jump onto that question right away. You could call it a burning question or a hot pursuit question, and we'll pause the conversation at that slide and get into it right there. Otherwise, we'll save them for the end. And then finally, I'm going to set the conversation to be muted so that we don't pick up any background noise. But in any case, just ask you to make sure that your microphones are muted, particularly those colleagues on the phone. And towards the end, we'll remove that mute feature and we can get more into a round conversation. So with that, again, thanks very much for joining us. That's more or less the last you'll hear from me. We're here to hear Jeff. And so, Jeff, over to you.
Great. Thank you, Ted. It's a pleasure to join you all today and to talk a little bit about EMPEA and some of the trends we're looking at across the private capital universe in emerging markets. As Ted alluded to just now, EMPEA is a global industry association dedicated to private equity and venture capital, private credit, infrastructure, and real asset strategies across emerging markets. We're based in Washington, D.C., the staff's all in DC, but our board of directors, our advisors, and representatives are based in global financial centers around the world and, of course, in emerging markets themselves. And the membership at EMPEA it includes fund managers, as well as institutional investors and DFIs, as well as service providers, so accounting firms and law firms, et cetera. And the strategies of our members span from what I would call maybe purely commercial, all the way to more impact or development-oriented investors and fund managers. And in terms of the size of some of the individual firms, we go from single country fund managers with an AUM of around, say, 20, 30 million, all the way up to some of the largest alternative investment managers in the world, so the likes of KKR and Carlyle. So it's a pretty diverse group, and as a result, our remit in terms of the research that we do is pretty wide. Ted just mentioned a few of EMPEA's research and data products. That includes our Global Limited Partners Survey, which gathers the perspective of investors in private equity and venture capital funds across emerging markets, and we'll share some of that data with you today. Just a note on what we cover in terms of our industry statistics before we start. Our program is traditionally focused on conventional private equity and venture capital and infrastructure funds. So by that, I mean the numbers that you see are going to exclude strategic or corporate investors. They're going to exclude direct investments from DFIs and other institutions. So what you're going to see is probably a little bit more restrictive in scope than what other providers will offer, but we think because of that, it gives a pretty accurate picture of what's happening within the corner of the market that we would call institutional or investable for limited partners in private equity funds. Okay, so just to briefly go through what we're going to talk about today, I'd like to take you through a few of what we consider to be the most relevant trends that we've seen in emerging markets over the last 5 years. So that includes the rise in prominence of strategies that have not been associated with the emerging market space in the past. So that includes private credit, venture capital, and technology, which we'll spend some time talking about. The next big trend or issue would be regional divergence. And Specifically, I'm talking about what's happening in emerging Asia versus other EM regions and countries, and the role of currency volatility in some of that divergence. Then we'll have a little bit on sustainability and impact, and what role that might play in the private capital space going forward. And then we'll take a closer look at private capital in Africa, not only because Ted mentioned that the region is of particular interest to you, but also because I think it exemplifies a lot of the challenges that we face in emerging markets. So we'll take you through some of the information we have there. So just to move into the first section, we'll give you kind of a high-level view of how the industry has grown over the last 2 decades, and then talk about that shift in the composition of strategies that I mentioned just now. Okay, so I'm looking, for those on the phone, I'm looking at slide 5. As you can see, over the last 2 decades, the amount of capital raised by private capital fund managers investing in emerging markets has grown by an order of magnitude. So whereas in the early years of the new millennium, there was less than 10 billion raised on an annual basis for funds devoted to investing in emerging markets, last year these same fund managers raised over 60 billion. And as you can see, there was obviously a dip in capital raised associated with the global financial crisis. But one of the interesting things was that many emerging markets recovered more quickly than the industry in developed markets. So you saw the share of global activity actually peak up in those years. So just moving on then. Even though more capital has been raised in recent years for emerging markets, one of the more important things to highlight is that whereas once private capital in emerging markets really meant growth equity, traditional growth equity, so investing for minority stakes in typically family-owned SMEs that operate in traditional industries, that's no longer really the case. So a lot of the growth at the margin across the asset class writ large has been in areas like private credit, in venture capital, and in infrastructure. So you can see the share for those strategies in the colors at the top, going from approximately 20% in 2012 to now more something along the lines of 40% in the most recent reporting periods. So I think that's important because insofar as one of the criticisms of private capital or private equity in emerging markets is that it is only minority investing. That's not necessarily the case. Investors are operating up and down the capital structure and committing to not just operating businesses, but also in areas like renewable energy as well. And also, as we'll see on this next slide, in the technology space. So investor sentiment toward venture capital in particular has really changed over the last 5 to 7 years. In the most recent edition of EMPEA's Global Limited Partner Survey, the highest percentage of respondents plans to begin or expand investing in venture capital as opposed to some other strategies. And you can see the growth over time from 2014 to 2016 to 2018 in the percentage of investors looking to expand commitments within the venture capital space. And I would note that the data on this slide, number 7, includes both what you would call traditional commercial investors as well as development finance institutions. So they have actually been some of the leaders in backing new VC teams in places like the Middle East and Latin America. So an indication of where investor sentiment is going. And then you can see that change in investor sentiment really translating in the amount of capital being raised for venture capital strategies here on slide 8. So the amount raised in 2016 was the highest we've ever recorded. So over $11 billion going to emerging markets venture capital strategies. And while the vast majority of that does go to emerging Asia, there are new teams popping up across the African continent, in Latin America, and in, say, the buyout space at the other end of the market. One of the trends that we've noticed is the largest funds attracting a greater share of all capital. In venture capital, that's not necessarily true. So there have been a number of spin-outs, a number of new teams that have formed. So the depth of the pool of fund managers who are pursuing VC strategies has grown across all regions. And you can see that on the right, where we're looking at capital raised and the number of funds raised for first-time fund managers. So for new GPs, essentially. And GP, what I'm referring to there is a fund manager, general partner. Okay, and one of the things to highlight for you here when we're talking about venture capital is that when you look at the performance of private equity and venture capital globally over longer time spans, you can see that emerging markets venture capital is something of an outlier. It's done better than private equity and venture capital strategies in other regions, and even compared to emerging markets private equity. So what's driving this? Well, I think given a longer history and the number of fund managers comprising the sample, Chinese venture capital in particular has done extremely well compared to the global data set, the global sample. So everyone knows about the likes of Alibaba and Tencent. I mean, originally those were venture capital backed companies once upon a time, and those biggest Chinese tech groups have been joined by others in their wake. So that includes Meituan, Dianping, and JD.com, and on down the line. So that's really been perhaps the most commercially successful segment of the alternative landscape globally. So perhaps I'll pause there, Ted, and ask if there are any questions or anything I can help shed some additional light on.
Thanks, Jeff. For our colleagues joining us, any questions at this point?
Okay. Well, in that case, we'll just keep moving. So I talked about venture capital, the outperformance of early stage investing in Asia. And now we're going to switch our attention and talk about some of the other regions. And we'll start with looking at what limited partners who respond to EMPEA's survey indicate are factors deterring them from committing more capital to different markets. And the broad story with this exhibit on slide 11 is that you see a difference in the likely deterrence when you look at Asian markets, and then you look at, say, Russia, Turkey, Brazil, and broader Latin America, and then the Middle East and Africa. So whereas in Asian markets, investors are more likely to indicate that competition is a factor in their decision making, that they feel that there's too much capital going in, or there's too many funds operating. In other EM regions and countries, political risk and currency risk are much more relevant, and the perceived risk associated with these factors is higher. So it's worth asking why that might be the case. When we ask investors specifically what effect currency volatility has had on their realized investments in emerging markets, private equity. Nearly 3/4 indicate that currency movements have actually subtracted value from their realized investments. And another thing to keep in mind as context here is that the vast majority of funds that operate in emerging markets are US dollar denominated. And in turn, the limited partners invested in those funds are most likely to be hard currency investors, even the largest DFIs committing to the space. So while there are local currency funds and local investors that invest in a few markets, so South Africa springs to mind, China obviously, Mexico, Brazil, Colombia, there are local pensions that invest in the asset class. The vast majority is still US dollar denominated. So when you have substantial currency movements, especially in a negative direction, this can very severely affect the stated performance of any given fund. And just to move on to slide 13, what you're looking at here are short-term rolling returns for different EM regions. And you can see, so for instance, each data point on this slide is essentially representing the 1-year return leading up to the end of the reporting period. So you can see that there's a big difference between the experience in emerging Europe, in Latin America, in Africa, where returns grew sharply negative from the period from approximately 2014 to 2016, compared to the experience in emerging Asia, where currencies have proven to be more stable and not subject to the kind of wild swings that other emerging market countries went through. And obviously what we're seeing here, I think it's fair to say, is some effect of the commodity downturn, of some of the political events that have happened in these markets, and then resulting currency volatility. And of course, now what you see in the news is that we're sort of going through a similar bout of volatility. And of course, it's affected currencies in regions outside of Asia more severely than it's affected Asian currencies, at least up to this point. So actually, before moving on, I would like to take a moment to mention that if you're interested in these issues of currency volatility and what can be done about it, EMPEA actually contributed to a study that was funded by USAID and led by Sirona Asset Management and Serge over at Sirona. And we also worked with 2 groups called Chrysalis and Portico Advisors on this report, but it really explores this issue in more depth, and I think we'd be happy to share a link or pass that along as one of the follow-up items to this call. Okay, so what is the upshot of this divergence in different levels of volatility in currencies and political stability across emerging Asia versus other emerging markets? Well, what we've seen when we ask investors to indicate how attractive they perceive to be any given market is that Asian markets more recently have come out on top. So in our 2018 market attractiveness rankings, which form a pretty popular part of our global limited partner survey, you see Southeast Asia leading the way, followed by India and China, and then other emerging markets following in their wake. So whereas once sub-Saharan Africa, Latin America ex-Brazil, Brazil itself led these rankings in, say, the 2011, 2012, 2013 period. In more recent editions of the survey, investor sentiment has cooled. And just to mention on this slide, one of the quotes from the LP survey talking about Southeast Asia and some of the fundamental factors that drive interest in that region, I think it's safe to say that those fundamentals are also present in other regions. It's just that some of the instability that we've witnessed has kind of maybe clouded the picture a bit. Okay, and maybe in the interest of time, I'll kind of skip over this. So not only has investor sentiment started to tilt towards Asia, but you can also see that in the fundraising record. So when we look at the percentage of all capital raised for emerging markets that goes to emerging Asia versus other regions, historically, I mean, Asia, by virtue of population and the size of the economies there, you would expect it to make up the majority. Historically, this has been about 2/3 of all emerging markets activity. But in more recent years, we're shifting more towards 80 or 90% of all EM fundraising activity. So what is perhaps the silver lining in all this? Another measure that we use to assess investor sentiment is we ask respondents to our Global Limited Partner Survey what level of their commitments to emerging markets funds are likely to move toward in the next 2 years. So based on the percentage that indicate they plan to increase commitments over time, we can get some sense of where market feeling is at. And you can see that the proportion of respondents on the left-hand side of slide 17, you can see that the proportion of respondents that plan to increase their commitments declined from the period from 2014 to 2016, but that it's since ticked up. And then when we ask investors about their return expectations, so what proportion expect returns of 16% or more, which is also an indication of sentiment, you can see that on the right-hand side of slide 17, that's improved for most of the regions and countries that we include in the survey. So the question then becomes, when will this improved investor sentiment for not just Asia, but other regions where people have the feeling that the worst is over, when will that translate into more commitments from especially commercial institutions to Africa, to Latin America, to emerging Europe and the Middle East? That's sort of the point we're at right now. Okay, so just a word then on sustainability and impact. As I mentioned earlier, EMPEA's membership really spans from investors with a purely commercial outlook to 100% impact investors. But we wanted to get a sense, because we view this as a strategically important area for our organization, we wanted to ask respondents to the Global Limited Partner Survey how aware they are of environmental and social impact and its importance in their investment decision-making processes. So we did this for the first time in the last edition of the survey, which was released in May. And what we found was that 3/4 of institutions responding to the survey take environmental or social impact into account when they're making investment decisions. But then when we asked this same group if they had a dedicated allocation to impact investing and what percentage of their total assets were dedicated to impact investing, you can see that the majority of this group does not have a dedicated allocation to impact investing. And I should also note that this analysis excludes investors such as DFIs, government agencies, and LPs that we know to have impact mandates, because we wanted to get a better sense of where commercial institutions were along the spectrum in terms of their thinking. So in many ways, this is great news that so many institutions are thinking about impact, which I think if you asked the same question a decade ago, you would probably get you could probably get an inverse outcome where 3/4 did not take environmental and social impact into account when making investment decisions. But then, especially for fund managers that are managing impact funds, if most institutions don't have impact programs, I think they're probably wondering what it's going to take to get it over the line, to get LPs to commit to their funds. One of the other questions we asked is what factors or criteria investors associate or consider to be essential to impact investing. And you can see there's a broad consensus on the importance of having self-identifying as impact and having an impact thesis from the start, to measuring and reporting, but that there's sort of a weaker association between impact investing and commercial returns. So I think this is revealing in the sense that you might not see most commercial institutions embracing impact investing or the idea of impact until they can really see a correlation between commercial outcomes and the amount of attention paid to these factors. So I think it's just it points to kind of where we might be in the development of this idea and its application to private capital. And then just on one more note here, we do look at what percentage of the private capital space that we cover is made up of impact dedicated funds. And you can see that this has grown. When you look at the full span of our data set from going back to 2008 to the present, especially in recent years, there have been some sizable impact funds raised for emerging markets. But in the context of approximately $60 billion raised on an annual basis for emerging markets private capital in 2016 and 2017, the impact share is still just a small fraction of that. So happy to talk more about sustainability and impact later on during our discussion. Okay, so then just to switch gears again, we've talked a little bit about the role of venture capital and the technology ecosystem, about currency volatility, and I think Africa sort of as a region is sort of a microcosm of some of those issues. So this past spring, EMPEA published a brief on what we see to be the road ahead for African private equity. And we thought it would be a good time to assess where we are, because we've just gone through a cycle where a lot of capital was raised for Africa-focused funds, where investor sentiment really peaked in the early years of this decade. And then everyone knows kind of what happened next, right? There was commodity downturn, a lot of currency volatility, Nigeria entering recession, South Africa exhibiting a lot of economic and political dysfunction, and then maybe Kenya as an outlier that is kind of not really exhibited some of these other characteristics and has kept on growing, and everyone's excited about the tech ecosystem there. But even there was political matters that received a lot of coverage, and I guess all these economic challenges that the region has been facing, or that especially the largest economies in the region have been facing, have put a lot of constraints on GPs locally. They have or had a lot of capital to put to work. They had currencies moving against them. The portfolio companies that they've invested in have been under strain, and you can see that translate into fund performance for the region. And I think it also kind of asks a question of whether the traditional growth equity model is perhaps the best for the region, given the inability to especially if alignment with the promoters of a company is not kind of lockstep. How do you take swift action to help companies out of a hole when times get tough? So that's sort of some of the issues that we set out in this brief, and then we asked ourselves, okay, given all that, where are some of the bright spots? Where are some of the opportunities? And why does the region still remain attractive for institutional investors? So one of the things that everyone who's had experience investing in private equity in Africa would be aware of is one of the criticisms of private equity in the region is that there are relatively few large established businesses to invest in. And just to give you a sense of that, on slide 24, we're showing you some data on private companies from Isoko Insight, which is a great company, relatively new, and they're building this database of private companies across select African markets at the moment, but I think their ambitions are broader. So we're looking at data on private companies from Nigeria, Kenya, Ghana, Ethiopia, and Cote d'Ivoire. And you can see the vast majority of the companies in their database are quite small in terms of their reported revenue. So nearly 3/4 have revenue under 25 million. And I think that it's probably a good representation of what is investable, in the sense that these are companies with that are willing and able to sort of open up the books slightly and share some of these figures with a third party. So as I was saying, the vast majority of companies in the region are quite small. It's very fragmented across many sectors. So rather than, one of the things we asked ourselves in this report was, rather than viewing that as something that would limit the amount of capital that is able to be deployed effectively in Africa, it's worth considering that perhaps the model that's traditionally employed by private equity fund managers just needs to be altered slightly, rather than something that is fly in, fly out, and very hands off. That there needs to be a lot more intensive use of buy and build models, of deploying experts from fund managers with operational backgrounds in some of these companies, in order to help them really scale up and enter new markets, so that fund managers are able to build portfolio companies that have the scale and the resilience from being in multiple markets to be attractive targets for strategic investors. And we have started to see that in the investment data. So just looking at deals from the first half of the year, almost a quarter of all the investments that we've tracked would be what we consider regional platforms. So at the time of investment, fund managers going in and acquiring companies across multiple markets and kind of stitching them together. There's a great example of this from East Africa that was announced recently, where the GP was basically taking together mattress producers from Uganda, Kenya, and another market, and building them into sort of an East African platform. So that's a strategy that we think is relevant for the reasons I stated just now, which is companies like this can be more resilient across markets. They have a scale that proves attractive to strategic buyers, and they can help create the demonstration effect that will get more commercial capital into the region. So just the next thing to mention would be technology and the technology ecosystem within Africa, which we've seen grown a lot, even though it's coming from a very small base. And when you compare it to, say, Latin America, it's behind that, and obviously Asia is well ahead of where the other regions are in terms of the depth and the sophistication of the companies and everything. But this has really grown, and I think one of the potential implications for investors is that more deal flow is going to be coming out of, it's not necessarily going to be coming from family-owned businesses in the future, but perhaps more and more will come from this early stage ecosystem. So companies that grew up with venture capital investors, and are in need of capital to expand. And then you'll see private equity, what we would consider traditional private equity funds. So firms like, say, Helios, for example, coming in at the late stage, so Series C, Series D investments and beyond, and helping companies grow when they've reached a certain scale. And this being, I think this is something that you wouldn't have seen within the region 5 or 7 years ago. And I think if some of these companies that have technology-enabled business models, if they're able to provide solutions that really change the marketplace, and they're able to serve customers at lower incomes across many different countries, and if they're able to really make a meaningful difference in people's day-to-day lives in terms of cost and convenience, then I think that could really contribute to the ongoing transformation of the region's economies in a way that previous models really didn't. One other thing to highlight within the report is the constraints of the traditional closed-end fixed life fund. Most private equity and venture capital funds that get raised around the world are sort of a 10-year +1+1 model, which means that ultimately the fund managers, even if they've invested in great businesses, they have to sell them, right? They want to hold for 3 to 5 to 7 years and then move on and do new deals. Now, that pressure to exit can be complicated when the typical buyers for a company are not interested in a region like Africa at the current moment due to some of the economic factors we talked about earlier. So when we look at our exit data, and this only includes disclosed transactions, so I mean a fair bit of probably a pretty significant share of the exits that do happen are not disclosed. That's just the limitations of private markets and an ongoing lack of transparency that EMPEA wants to be part of fixing. I just wanted to mention that about the quality of the data. But for us, when we look at disclosed exits, it's clear that they peaked in, say, 2014, 2015, 2016, and that since they've really fallen off. So the typical buyers for businesses are not proving to be as active as they were in past years. And if these are, say, local African corporates, they could be under some sort of stress or distress themselves. We've seen a pullback of some of the European multinationals from Africa. So if you're faced with this and you're under pressure to exit a business, it might be best to kind of wait and hold and not divest right away. But you have the constraints of the fund life. So one of the interesting things we've seen some managers in the region do is adopt more evergreen or permanent capital models. And I don't think this will apply to all strategies, or it's not something that's going to replace the existing fund model wholesale, but it's just there have been some innovative approaches taken, and people are thinking really hard about how to solve some of the problems and then creating solutions to that. So I'll try to wrap up here pretty quickly, but I think it's worth just highlighting why the region would remain attractive for commercial investors, given when they look at the globe. I mean, they've put a lot of money to work in Western Europe, in North America. There's heightened competition, and in Asia, there's heightened competition in some of these regions for assets. It means entry multiples, deal pricing is going up. Africa compares favorably on that metric. Relative to other regions, the industry is still, I think, at an early stage. And so there are just fewer players, there's less capital going around than in more developed markets. And I wanted to include this slide. This is Moody's data on slide 29, because I think it gets at the fact that even with currency volatility and some of these other factors that we talked about, perceptions of risk in a place like Africa can be much different from the reality. So when you look at, say, project finance default rates, which will be especially relevant for those of you who invest in infrastructure and power and roads, et cetera, they're actually lower in Africa than in North America over the last few decades. And then finally, it's worth mentioning that even though the region has attractive fundamentals and there's a lot of room to grow and there's a great need for capital, that it will be incumbent on private equity and venture capital fund managers who are operating across the region to really shore up their ability to drive operational improvements and make transformational investments in businesses rather than relying on sort of an invest and hold, waiting for the broader economy to grow and kind of lift all boats kind of mentality. So one of the endowments we talked to when we were compiling this report really stressed this factor to us, that this is something that will be important, because if companies don't if fund managers don't have a kind of a backup plan beyond just relying on broader growth in the economy, then they'll face severe constraints to generating returns in poorer periods of growth when the economy presents more challenges. So why don't I stop there, and Ted, if you have any initial reactions or want to share some questions, then that would be great.
Great, thanks, Jeff. And just as a housekeeping point, I'll remind you to click over to, I think it's maybe one of your last slides where we've got your contact details as well if folks want to get in touch with you.
Sure. Can we ask questions, or should we? How do you want to do this, Jeff or Ted?
Yeah, by all means, please do go ahead and ask questions. I have one question that's come through already off the wire here. Our colleague Matthew McGrath at Van City wanted to raise a question around whether, Jeff, if you had any data or any directional perspectives on what the aggregate assets under management or average assets under management were for those who responded to your impact study. Or in other words, do you know what type of impact investments some of those respondents have made? I think we're trying to get a sense of sort of how does that market break apart, and where are you seeing different responses from different investor types?
Yeah, so why don't I just click back. So you're talking about this right here, the impact questions that we asked of the limited partners in our survey.
That's right. Yeah.
Okay. So we do actually track the reported AUM of institutions taking part. So I should be able to kind of break this down for you guys as a follow-up. It is always hard because we get responses from around 100 institutions every year, but there might be a limit to when we start to break it apart. There might be a limit to how informative that is, because then those groups themselves, just get smaller. But I think it's fair to say that at least anecdotally, in terms of limited partners in the EMPEA network, that it does really span from family offices and foundations that are much more limited in size, so 50 million, 100 million and beyond, all the way up to some of the largest pension funds. So I think some of you will be aware, like APG has a dedicated impact program, and that's a massive institution. So I wouldn't want to say, without looking at the breakdown one way or the other, if it skews one way towards bigger institutions or smaller institutions, but just anecdotally, I mean, I think institutions of all sizes are represented.
Okay, great. Thanks, Jeff. And a couple questions that Serge has put into the chat window there. Serge, I'm not sure if you want us to look at it that way, or do you want to just bring them out through voice?
Yeah, sure, I can do that. Really, the first one's probably the most interesting one to me. Just as background, Jeff, I chair, as you know, I chair the CAFIID board, and one of the things that CAFIID's trying to do is to scale more impact investments from Canada into emerging markets, particularly from institutional investors. And we know that at Sorona, at least, we know the investor market out there, and I mean there are some very individual investors and high net worth individuals that really care about impact, but institutional investors, particularly from Canada, tend to be not supporting much in emerging markets, and those that do don't really view the impact investment space. So I suspect my question for you is, what advice would you give us, given your experience working with some of these partners, about getting Canadian institutional investors not just interested, but maybe even excited about impact investing in emerging markets, and that that might link to that last question too, about how do we get them to become long-term supporters of this into the future, so that we can create a sustainable business opportunity for them, but also an industry that's sustainable and stands the test of time.
Yeah, I mean that's a great question, and it's a challenge for EMPEA as well, because I mean we were founded on the belief that private investment going into emerging economies would not only be attractive from a returns perspective, but also contribute to development of different regions and countries. So it's kind of like a tension that has always been present for EMPEA as well. And I think in Canada and specifically, I mean, you have some of the largest, it's really the largest, most sophisticated institutional investors globally, right? And I think you're right to identify that there isn't really much of an impact push from some of those institutions. And I think it just goes back to the question of returns and the commercial viability of some of the strategies. So what we would like to support at EMPEA, and what I think will make a difference, is just being able to link data on returns and successful outcomes to an awareness of impact, and incorporating environmental and social impact into the investment thesis, and kind of demonstrating how it actually contributed to financial value. I think that's really where a lot of the interesting work will lie in the years ahead.
Thanks, Jeff.
So I don't know if that addressed everything, but I just to add one thing, for I think stakeholders in this space were in development finance institutions or others. I mean, they have a lot of priorities that are all admirable, and one of them is the idea of private sector mobilization or bringing commercial capital along. So I guess my question is, how important is that relative to other goals? Because if that's the most important thing, then it really does come back to returns. But then with returns being the most important factor, there's a trade-off with maybe the degree of environmental impact you can generate, or the measures that are taken to address employment and employee welfare and that sort of thing. So that's definitely something to consider.
Thanks, Jeff. And I think we might have time for one or maybe two more questions. Cole, I saw you've put a question in here. Do you want to jump in and voice it over?
Yeah, sure. Happy to. Jeff, thanks. This has been really helpful. I think I just had a question on, as you guys have gone about doing some of this analysis, if you have done anything specifically to look at like types of deal structures and or enhancements to deal structures that, like when we think about a more of an immature market for PE or VC money, like Sub-Saharan Africa has helped to catalyze some of that growth and likely is, I think, well positioned to catalyze it in the future. I think one of the things that obviously kind of jumped off the page is compared to the Asian market, kind of looking at that difference between penetration. And I'm just kind of curious if you guys have looked at deal structure and enhancements to deal structures to understand that a bit more.
Yeah, so we have looked at a few things that might have an impact on returns or outcomes. So as part of the currency risk mitigation study we did with USAID and Sirona, there are some interesting solutions that are explored in that report that could potentially address some of the difference in outcomes from markets where there's a lot more currency stability to others that are proving to be more volatile.
Right.
So I'd encourage you to look at that. And then, I mean, there are sort of clauses and other deal structures that could perhaps lead to better outcomes for minority investors specifically.
Okay.
So trying to because if you're a minority investor in a business, right, and then say there's a family promoter who has ultimate control, options might be limited as far as if you want to sell and then being able to sell and that's something that a lot of fund managers that we speak to have kind of identified. So I think there's some things that can be done there in order to get more contractual liquidity, for instance, at the outside of the deal, and then get better outcomes there. And then I guess maybe the other thing I mentioned is the whole idea of blending, right, and what support donors can provide to, and maybe this is what you're actually getting at, the idea of what role concessional or concessionary capital can play in improving the outcomes. And there, I think, MP is probably not the leader in that specific area. And then I know you guys have Convergence Finance, right, up in the Toronto area, and I think the database they're building and everything. I'm really interested and curious to see what's going to happen there, because I'm sure they're going to be cataloging a lot of these different structures and approaches, and I think that's great.
No, that's helpful. No, totally agree. Thank you.
Great. Thanks, Jeff. We'll just give it a second more here and see if we have any final questions from our participants. We might have one last one coming in over the chat window here. Yeah, one last question there from Robert. Jeff, I'm not sure if you're able to see it in your window as well.
Let's see. Yeah, so would it be helpful if I just vocalize the question?
Sure.
For on the phone? Okay, so the question is, most institutional investors have a fiduciary duty to seek the best returns available. Have you seen any sign of investment committees considering changing investment mandates to allow concessional rate of return for at least a portion of AUM? I think in recent years, there has been sort of a push in this direction within the U.S. at least to allow fiduciaries to consider the environmental and social ramifications of their investments when they're making these decisions. But then I think there was a pushback on the part of some of the regulatory agencies in the U.S. With the new administration we're under against some of the changes in that direction. And then I think, generally speaking, if they're going to come from anywhere, I would say probably Western Europe or some of those countries are the countries in that region are probably furthest along. But there's not a really great example that springs to mind immediately. So apologies for that. But it's something we could, potentially look into after this.
Yeah, very interesting question for
Yeah.
sure, and I think it might even tie into, in a degree, tie into some of the thinking that Cole had in his previous question.
Yeah.
So listen, again, I think on behalf of the CAFIID membership, Jeff, really appreciate you taking the time and also being quite generous in sharing so much of this information that
Sure.
really is at the heart of, I know, what your organization does. Really appreciate it. I'm sure folks will have follow-up questions, so stay tuned on email. And for the CAFIID members, again, feel free to reach out if you have thoughts on upcoming webinars, if you'd like to participate in anything or showcase any of your own learnings. And details will come out in a month or so with regards to our November webinar.
Yeah,
Beyond that,
great. So actually, Ted, if you don't mind, if I could just,
sure.
I'd be remiss if I didn't mention that
I'm going to give you the last word then. Over to you.
Sure, sure. So EMPEA is hosting an event in London on the 23rd of October called Sustainable Investing in Emerging Markets, and we'd be delighted if you all found a way to join us for that event. We're going to be looking at the Sustainable Development Goals in particular, and how we can move from using them as a way of kind of retroactively looking at mapping investments to the Sustainable Development Goals to more how do we improve measurements and build an evidence base, and then how they can be incorporated in forward-looking strategy. So this is the third year we've done this event. We're going to have a great lineup of speakers and strategic partners for the event, and we'd really like it if you all could join us, and I'm happy to share more info if anyone wants to email me after this. So sorry, thanks, Ted.
Great. Thanks, Jeff. Thanks, everyone. Hope everyone has a nice weekend ahead, and we'll all be talking soon. Thanks again.